This is part 2 of our video lecture for Chapter 11, where we're continuing to work with S-type corporations. In the next few slides, what we're working with is a shareholder's basis in his or her stock from the S corporation. And the importance of this basis calculation is the balance in the basis account is typically what the shareholder can withdraw tax-free from the corporation as a corporate distribution. Or if they sell their shares, the balance of this basis account is what they can deduct as the cost of the stock they're selling. And the calculation is very similar to a partner's basis in his or her partnership interest with a partnership. So we start off with the initial basis. So if this is a new corporation being formed, you're again looking at that corporate chapter where we learn section 351 exchanges, where whatever property is being contributed to the corporation by the shareholder, the basis of that property will now be used for the stock basis. And we call that topic substitute basis. But we know that if there's boot being paid back to the stockholder, there's a possible gain that has to be recognized, and that will be added to the cost basis. But then you got to allocate basis to the boot equal to its fair market value, so that will reduce the remaining basis now allocated to the stock. So that's the starting point if you're forming a new corporation that has an S election in effect. Now, a simpler situation is if you have an old shareholder of an S corporation selling stock to a new shareholder, and that new shareholder's basis in their stock would just be whatever they had paid for it. So this will be comparable to a partner buying his or her partnership interest from an existing partner. And now that new partner would have a so-called outside basis different from the inside basis. Likewise here, a new shareholder buying their stock from an old shareholder, whatever is being paid is their initial basis. And typically that may not be even on the records of the corporation, because this transaction would have taken outside of the corporation. So now every year we're going to either increase or decrease the shareholders basis by certain things that happen during the year. The increases are grouped up here and the decreases are grouped in the second group, and they're kind of a mirror image of each other. For example, if the shareholder contributes now even more additional paid-in capital to the corporation, that's going to increase his or her stock basis. Likewise, if the corporation distributes cash or property to the shareholder, that's going to reduce the stockholder's basis. Another increase to the stockholder's basis is the amount of income allocated to the amount of shares being owned by that shareholder. Remember, we're dealing with an S corporation that is a pass-through entity. So whatever income or gain is being incurred by the corporation will now be allocated and taxed to the shareholders. Keep in mind, this is different than a distribution being paid to the shareholders. You don't have to distribute out any profits, but the corporation or the shareholder still has to report and be taxed on his or her share of those profits. Here it says even tax-free income earned by the corporation is going to be credited as a basis increase to that shareholder. And again, even though it's not taxed to the shareholder. And the opposite would be any losses or expenses incurred by the corporation gets passed through to the shareholders, and the shareholders can now deduct that on their individual returns, reducing also now the basis of their stock. Even non-deductible expenses, they can't deduct it on their individual returns, the shareholders, but they gotta reduce their basis. Here it says basis cannot go below 0. That may be true in the terms of distributions here. It cannot reduce the stock basis. But we'll see possibly something called a AAA account or part of the retained earnings account that may be reduced below zero. So here's an example where we start off the year with Nicole. Remember, that's the example where we have 3 shareholders. Nicole's basis in her stock is $115,000, and then during the year the corporation will allocate 1/3 of the business income to her, so that's $80,000. Remember, now this doesn't mean she collects $80,000. She's just credited with $80,000 of income that she now has to report and pay taxes on her individual return. And here's separately stated income, interest income she has to report, and dividend income, be it qualified or just ordinary dividends, that she has to report on her tax return. And another $400 of separately stated income that's not taxable. Now all of these items here is going to increase the initial basis. So now she has $198,400 of basis at the end of the year. And it is possible for her to withdraw out of the corporation $198,400 tax-free. Again, a shareholder can have a distribution tax-free equal to their basis. Also, if there's a loss being allocated, maybe a separately stated expense being allocated that the shareholder can deduct, or even not deduct if it's not deductible, it's going to reduce this basis, reducing now the balance that the shareholder can take out tax-free as a corporate distribution. Also, again, the importance of this basis here is this is what the shareholder can deduct if, in this case, Nicole sells her stock to someone else or gets redeemed by the corporation. So now let's allocate losses or expenses to the shareholder. Here we're told that the losses that are usually deductible by the shareholder is going to reduce their stock basis, and that's what we've been talking about in the past couple of slides. But also, if you still have more losses in the stock basis, the shareholder can deduct some more. If you remember back in the partnership chapter, partners are allocated their share of the partnership's liabilities. That's not true for S corporations, but maybe if the shareholder had directly loaned money to the S corporation, so now the shareholder is a creditor of the S corporation, whatever they're lending to the S corporation is also basis they can use to offset any losses to be claimed by the shareholder. So not only do you look at the basis of the stock that shareholder has, but also the basis of any loan the shareholder has lent to that corporation. Now, we saw in a past couple slides, if there's increases like contributions made by the shareholder or income allocated to the shareholder, that's going to increase the basis of the shareholder's stock. But if you had used up part of this basis in the loan in previous periods, whenever you have an increase, the increase is going to be allocated first to the loan amount to bring it back up to its original balance. Only then, if there's anything left over to increase, that increase will go to the stock basis. It's quite common for very small S corporations, maybe just one shareholder, not just to invest capital into the corporation, but also to lend money, debt. And if the basis has gone down in this debt and the debt is repaid back to the shareholder, there's going to be income being reported, taxable income to be reported by the shareholder, because the amount being collected by the shareholder is going to be less or more than the basis in that debt, and the difference, or possibly an allocation of that difference, is going to be taxable to the shareholder, which kind of makes sense because they already took a deduction for the basis in the loan in a previous period. Losses not deductible due to tax basis limitations. Again, they don't have enough basis, be it in the stock or debt lent to the corporation, gets suspended until a future period where the shareholder can increase the basis, either through contributions to the corporation or income being allocated to the stockholder. So, and that income is going to be taxable, but now it also releases the losses that were suspended from the previous period, and it'll possibly offset, hopefully it will offset each other. Here it says that if the shareholder sells their stock, or possibly this, and we'll see in a future slide, the corporation is no longer a S corporation. Possibly the suspended losses that weren't used may disappear. We'll see an exception to that, at least a temporary exception to that. As we saw before in previous chapters of our semester, there could be limitations to losses, and one would be the so-called at-risk limitation. What's the maximum amount you can lose economically in your investment? And that's the amount you're limited in deducting over the lifetime of your investment. If you remember, non-recourse debt, the person borrowing that money is not liable for any deficiency, so they cannot deduct that amount of their non-recourse debt losses. Let's see. Let's go through this example. Suppose at the beginning of 2019, Nicole's basis in her CCS stock is $14,000, and then during the year, she lends $8,000 to the corporation, and the corporation has a $60,000 overall loss. Remember, she's a 1/3 shareholder, so her share of the loss is $20,000. So the first thing we do is use up this stock basis of 14. So now leave another 6,000 of basis we need. So now here is the loan Nicole had lent to the corporation. So that can be additional basis we use. So 6,000 minus out of this 8 leaves you a basis in the loan of 2,000. So all of the 20,000 allocated to her of the loss, she can deduct this year. But now her stock basis is down to 0. And then her loan basis was 8,000, but because you're using 6,000 of it to deduct that loss, the loan is now only $2,000. Now, well, let's take a look at the next slide here. Suppose the next year CCS allocates 9,000 of business income to Nicole, and then there's nothing else happening. So she's going to recover her basis first in her stock. We're going to bring that basis up from 2 to 8. So we're going to use 6,000 of the income. Remember, she has to report all of this 9,000 of income as taxable, but 6,000 of it is going to be allocated back to her debt to bring up the debt basis to 8,000. And the rest of the income, 3,000, again, she has to report this as income, is going to be allocated as stock basis to the stock. Notice now in this example, she had no withdrawal at all. She didn't take out any money, but she has to report income here, at least for this 9,000 being allocated to her. So let's say that the corporation still is in existence, but it loses its S election, either voluntarily or involuntary termination. And if there's any suspended losses at that point, you still have usually 1 year. It could be longer, but typically 1 year from that point in time to create any basis for the shareholder. And typically what we're looking at is contributions of stock, of money or property to the corporation. You cannot increase basis anymore by allocating income to a shareholder because you're not an S corporation anymore after the termination. And if you cannot use up all the loss after this 1 year post termination period, then all those suspended losses get permanently lost. That's a waste, at least for tax purposes. Again, just like at-risk rules, we've learned about passive loss limitation rules during the semester. The general rule is that passive loss can only be deducted against passive income unless and until it gets suspended, until the passive investment is sold, exchanged, disposed of, or if the corporation or if the shareholder sells their interest in the stock. And at that point, then the shareholder can deduct any unused passive losses. This is a new rule beginning for 2018 under the Tax Cut and Job Act. Remember, now we're passing through business losses either from a partnership or an S corporation to its shareholders or partners, and they can deduct business losses to the extent of any business income. And if you still have extra business losses, in the case of single taxpayers, they can deduct another $250,000 of losses against other income. Or married filing joint, you can double this amount of losses again to offset other income. Other income beyond business gains, business income. Okay, so again, this is a limitation beginning, a new limitation beginning in 2018. And if there's unused losses, you just carry it over to the following year, again subject to the same dollar limitation. We saw back in the partnership chapters, partners have to pay not just income taxes on their share of the partnership income, but they also have to pay Social Security taxes on their partnership income. That's not true in the case of shareholders of S corporation. Whatever is their share of the corporate income, that income is subject to income tax, but it's not subject to self-employment tax. So a lot of taxpayers use this potential tax saving device to do some tax planning. It's quite common for S corporations to do this, but you have to be careful because you have to pay the shareholder, if they're a hard-working employee of the corporation, a fair salary. And salaries, unlike corporate distributions or allocation of income, is subject to Social Security taxes, half withheld from the pay of that employee, and it's matched by the corporate employer. But again, if you don't pay anything to the employee and just distribute the profits as an S corporation shareholder, that profit is not subject to the self-employment tax. So you gotta pay that employee, be it the owner or others, a fair salary and subject to the Social Security tax. Now keep in mind, when you pay a salary, that's going to reduce the profit of the corporation. In turn, that's going to reduce the shareholders' share of that profits to be taxed on their corporation. Okay, so from the taxpayer's point of view, they want to reduce the salary and increase the profit to reduce overall the Social Security taxes. Fringe benefits, the main thing here is that shareholder employees that typically have more than a 2% interest are going to have limited tax benefits, tax-free benefits. In the case of employees who are not shareholders, or they own 2% or less of the stock of the corporation, you just treat them as regular employees, and they may be able to receive tax-free fringe benefits whenever it's available. The one that is probably most the generous one that is not available to this type of shareholder here that owns more than 2% is health insurance benefits. The corporation still can pay it for the shareholder employee, but it's going to be treated as a taxable benefit. There may be deductions available for the shareholder on their individual return, but any type of benefit like this is going to be taxed to them if paid by the corporation. Other types of fringe benefits that may be limited in terms of being tax-free is also retirement benefits, or at least the funding of the retirement benefits. So let's talk about paying the shareholders, probably distributions or dividends. And let's assume that there are no earnings and profits. You remember that term back in the C Corporation chapter? It's very comparable to a corporation's retained earnings, although there's some adjustments compared to retained earnings. So to the extent there are no earnings and profits, at least when the time the corporation was a C-type corporation, any distributions to the shareholder to the extent of their basis, again, is tax-free. And if you get more than that basis, the excess is going to be treated as a capital gain, probably a long-term capital gain if they held their stock for more than a year. Again, the key thing here is if you start off as a C corporation and you convert to an S-type corporation, any earnings and profits, let's call it retained earnings while you are here as a C corporation, will carry over as an S corporation retained earnings. And any retained earnings you earn as an S corporation, this is going to be part of your basis here. Retained earnings you've earned while an S corporation. This retained earnings that had carried over, which we assume none here, is going to be credited or charged whenever you have regular dividends, which we'll take a look here in the next slide. So now we have a corporation with earnings and profits. And the only way this can happen is if our S corporation first started off as a C-type corporation. So if you already started off a new corporation as an S, you're not going to have any earnings and profits. This only happens here with earnings and profits if you initially was a profitable C corporation and you didn't distribute out all the profits. So now you're an S corporation and you're earning profits. Those profits will go into an account called a AAA account, accumulated adjustment account, adjustments account. This is comparable to retained earnings while you're an S corporation. And here's the retained earnings while you were a C-type corporation that carried over from your previous C-type life. Okay, so again, this is from the S and this is from the C. And both you can kind of consider them to be earnings and profits or retained earnings of the corporation. So now when a corporation, S corporation pays out dividends, it's first going to come out of this current type earnings and profits. They're going to be tax-free to the shareholder. Then once you use all of that up, then it's going to come out from this taxable earnings and profits, probably as ordinary dividends, maybe qualified dividends that you can tax at the lower rates. And once you use up all of the earnings and profits, only then you start to eat into the basis of the stock. That's the capital contribution or the purchase price of the stock. And once that is all used up, then any excess is going to be a capital gain. Again, the order you use up the distributions is tax-free retained earnings, the AAA portion, and then earnings and profits when you were a C-type corporation. Again, if you already started off as an S, you're not going to have any of this. And then you start up to use the basis in the stock, the paid in capital amount with a purchase price of the stock. So again, here's that AAA. Think of this as the retained earnings of the corporation while it's an S corporation. You start off with the beginning balance. It's zero if it's a new corporation. And then any income earned by the corporation, eventually this is going to be allocated to the shareholders and taxed by the shareholders, not taxed by the corporation. Included in this is also tax-free income. You still allocate it to the shareholders and you credit them for their basis, but it's not going to be taxed to them. Here's separately, that's separately stated. Here's the regular business income being added in. And just the opposite, here's the ordinary losses being subtracted out, and also separately stated deductions being subtracted out. Just like tax exempt income added here, here is, this is excluding tax exempt income. It still adjusts the stock basis but doesn't affect the retained earnings account, this AAA account. And likewise, any expenses related to tax exempt income is not taken into account for the AAA account, but it does reduce the stock basis. And then here is what we're looking for. Money coming out tax-free using up the AAA account to get the balance at the end. This balance cannot go below zero when you have a distribution. This balance here can go below zero if you have losses here in being incurred by the corporation. Basis is a kind of difficult concept here because you have two sources of basis. One is the cost of the stock, the capital contribution, the purchase price of the stock, and the other is the amount of this AAA account. So if you're a 50% shareholder of the corporation, half of this AAA is your part of your basis, again added to your capital contribution, and you can get that all tax-free from the corporation. Okay, so let's look at this example here. It's not the best comprehensive example, but covers a couple of the topics we just covered in the past slide. Before considering distributions, the corporation's AAA account was $24,000. Keep in mind that the AAA account is not really allocated to individual shareholders. This is for all of the shareholders. So again, if you own half of the stock of the corporation, half of this AAA is for you. This is unlike keeping track of cost basis for a partnership, or at least the share of the profits for a partnership. Okay, and then accumulated earnings and profits. Remember, this is from the time they were a C corporation, is $40,000. Assume Nicole's basis in her stock is $80, and if CCS distributes $60,000, she's a 1/3 shareholder, so she's going to get $20,000. The question is, what is the amount and character of Nicole's 20,000 share? So let's take a look at the calculation. Again, this is not the most comprehensive and it's not the most logical, but let's follow the explanation here. So here's the total being distributed to all three shareholders. Here's the amount in the corporation's AAA account. So the amount of AAA being used up is the lesser of 1 and 2, or all of the 24,000 is being used up. This is tax-free. So 8,000 of that 24,000 is a tax-free distribution of to Nicole. Then here's the basis of her stock. and we used up 8,000, so now what's left over is 72,000, and she's still getting more money than the 8,000, right? She's getting 20,000. So the next $12,000 is coming from, not from the AAA. We've already used up that. Her share was 8,000. This 12,000 is coming from the corporation's earnings and profits. So that's more than enough. Here's all three show that's more than enough to cover the rest of the distribution. And whenever distributions are made from earnings and profits, the distribution is taxed as a regular dividend. So the total 20,000 received by Nicole, 8,000 is tax-free. Again, this is coming from the AAA account. And then the rest, 12,000, is coming from the earnings and profits, taxed at regular dividends. Now, if all of the retained earnings and profits get eventually used up, only then you start to use up the rest of Nicole's stock basis as tax-free distributions. But you gotta get rid of this earnings and profits balance. Only now it's down to let's see. Well, whatever you used up is going to be again reducing the earnings and profits balance, and then the rest carry over to next year. And once that earnings and profit disappear, only then you start using the stock basis tax-free. And if you get more than the stock basis, the excess would be capital gain. We've seen property distributions, not cash distributions, but property distributions in past chapters. And in the case of C corporations, we saw that is a taxable situation. If the property has a fair market value bigger than the basis to the corporation, the difference is going to be a gain reported by the corporation. In the case of an S corporation, now it's going to pass through to the shareholders. Also, it could be tax-free if it's coming from AAA account to the shareholders, or recovery of basis, stock basis could be tax-free, but again, it's going to be taxable to the corporation. If there is a loss that's being realized on the distribution, the loss is not recognized, just like a C-type corporation. Only if the corporation is going to liquidate a distribution in view of liquidation, only then you would have gains and losses probably being reported on distributions for the last year. So we're gonna terminate our S election, be it voluntary or not, and then we have a balance in the AAA account. And just like we've seen in the case of unused losses, remember those suspended losses because we don't have a basis, the same thing is true in the case of AAA account. Remember, AAA account is good. This is what you can take out as distributions tax-free. But if you're no longer an S corporation, this AAA will still be there for tax-free distributions for one more year after the S election has terminated. Okay, so it's best to use this up if possible. Otherwise, then it gets lost forever. Here's the liquidating distributions. So again, you're going to be distributing property to the shareholders, and now both gains and losses are going to be recognized, and then the gain and loss is going to be passed through to the S corporation shareholders. So typically S corporations do not pay income taxes. The income and the losses are reported by their shareholders, but there's always exceptions, right, to the general rule. Here's an exception. If a shareholder contributes appreciated property, and if the property was sold, there's going to be a gain. But when the But if they don't sell the property, the gain is going to be unrealized. And if the corporation hangs on to that property for 5 years, then all you have to do is report the gain and pass it through to the shareholders. But if the unrealized property gets sold before 5 years, now the corporation is going to pay a tax just like any other corporation, a C corporation, here at the 21% flat rate for corporations. This is to prevent the double taxation, or this is to prevent you from avoiding the double taxation of a C-type corporation. If you sell the asset at a profit and that asset had carried over from the C-type corporation, they're going to tax you anyway. We've seen this term, net passive income, and if you had too much of it, too much meaning the net passive income is more than 25% of your gross income for the whole corporation, and that lasted for 3 years, that could cancel your S election. But also, it may cause the corporation, the S corporation, to pay an income tax. The thinking here is that if you have earnings and profits when the corporation was a C-type corporation, they want to force you to start paying out dividends, and the shareholders get taxed as ordinary income. So this, again, 21% rate on this excess net passive income only applies if the corporation has earnings and profits. If you don't have any earnings and profits at the time you are a C corporation, then this tax would not apply. Let's look at one more tax that the S corporation may have to pay. Again, S corporations do not generally pay income taxes, but these are exceptions to that general rule. And this last exception is if you remember the terms FIFO and LIFO. Many corporations that deal with inventory during an inflationary period like to use LIFO method because that will save them taxes. Well, when you elect to be an S corporation and you are using LIFO, the government is going to charge you a fee for that conversion equal to the bigger FIFO basis of that inventory minus the LIFO basis you have, and that difference they tax you at 21%. It taxes the C corporation just before it turns into an S corporation at that 21%. Although the nice thing, if at all, there's a nice thing, they allow you to pay this so-called LIFO recapture tax over 4 years without charging you interest. Okay, so that's the lectures now for S corporation. So we've already covered C type, we've already covered partnerships, and here in this chapter 11, now we've looked at the combination of the two as a S type corporation.